Okay, we're going to go ahead and get started. I want to welcome everybody to another installment of the GA Featured Speakers Series. I'm Steve Garrell. I'm a principal and a financial advisor with GA Investment Management. And on your Zoom, there's a place that you can click and you can type in any questions. And we're going to ask our panelists to answer those questions at the end. For folks that cannot tune in live, we will have this on our Facebook page as well as on our website. So that's exciting. We've had good response to these featured speakers, and we're really excited today to have with us Bryce Gill, an economist at First Trust. And First Trust is a great partner of ours. We use a lot of their investment products, especially in the exchange traded fund area. Bryce is a member of the economics team at First Trust. He works directly with Brian Westbury, including the creation of their weekly Monday morning outlook. And Bryce is based in Texas. Are you getting some bad weather in Texas these days, Bryce? Are you missing most of that in Austin?
Oh no, we've been getting poured on for like a week and a half straight.
Oh boy, crazy weather. But even though Bryce is from Chicago, he went to Miami of Ohio for his undergrad degree in economics, where my brother and his entire family went to Miami of Ohio. So we have that in common. And he's currently working on his MBA at University of Texas in Austin. So I'm going to turn it over now to Bryce. He's going to give us an economic outlook. And boy, I can't think of a more uncertain economy than we have right now, Bryce. But thank you so much for joining us today.
Yeah, well, hey, absolutely. Thanks for that great introduction. Thanks everybody that's joining us today or watching sometime in the future online. So my name is Bryce Gill. I'm an economist with First Trust Portfolios. I've been working with our chief economist for about 6 years now. Doing little one-page analysis of the economy, traveling around the country, talking to financial advisors, and I got to say. The COVID recession has been, a very formative moment in my career. It's definitely been, one of the most interesting macroeconomic events that we've ever seen. But I do think that over the past several weeks, we've started to get some green shoots in the economy, and it's nice to be able to share some positive news after, about 2 months there where we were having that second wave of cases where every day I was just getting up and it was bad news after bad news. But, we're starting to travel again. I was recently on a plane for the first time in 6 months. I recently went to a movie theater for the first time in 8 months. I went and saw that movie Tenet. It's like a time travel movie. I don't even know what happened in the movie, to be honest, but it was good just to be in there with my overpriced popcorn again. So, if I'm going to movies, I'm getting on planes. A lot of other people are as well. It seems to be showing up in the data, and it does look like the recovery in the United States seems to be reaccelerating after a pause there for that second wave of cases. So, with that kind of introduction, we'll talk about the labor market today. We'll talk about COVID, obviously, and then we'll end with some talk about the election, because obviously the election seems to be a big source of uncertainty, and along with COVID, 2020 is lining up to be one of the most interesting or kind of scary years that we've seen in a long time in the United States. So, like I said, guys. I titled my presentation today, Recovery Reaccelerating. We'll get into why. We'll talk about that a little bit. But the first thing I want to start with here is just kind of some chronology of the pandemic so far in the United States. We've all pretty much, seen charts like this at this point. We've all become amateur epidemiologists, but this is just the daily case curve in the United States. And, kind of the main thing I want everybody to take away from this is just, like I said, the chronology of what's been happening so far. So, early on in the pandemic in mid-April, we peaked at about 30,000 daily new cases in the United States. And then we saw some pretty consistent declines in the case curve. And right up to around, I'd say, June 10th, June 15th. And we really saw this this big surge in cases, peaking at over twice as many daily new cases as we were finding early on in the pandemic. Some of that is just that we have a lot more testing available than we did early on in the pandemic, but it does look like, it was clearly community spread going on. So, just keep that kind of June 10th, June 15th date in your mind, because it'll kind of come up in future slides. But, I do want to touch on, the past week, we've started to see the case curve start ticking up again. And I think there's kind of maybe a couple things going on here. One is it could be basically all the kids returning to college, right? We know that colleges are testing like crazy, trying to keep this virus under control as students return to campus. But I will say, if you look at the positive test rate, which is a good measure of community spread, there hasn't really been any kind of consistent uptick in the positive test rate. So that kind of tells me that, this recent uptick that we've seen might just be because of rising testing levels in the United States, where, early on that hasn't really been the case. You can see early on during the second wave, we saw a pretty consistent uptick in the positive test rate. So, just kind of keep the chronology in mind there. Keep in mind, I don't think that this is the oft-predicted fall second wave yet. I think it might just be colleges or something like that. But, what I think is really interesting is kind of taking a look at the hotspot states from the big second wave of cases that we saw. So, the United States is massive, especially, comparing it to individual countries in Europe doesn't really make sense. So it's kind of more interesting, in my opinion, and kind of informative to look at it broken down on a regional basis. But what I've done here is just looked at Texas, Arizona, California, and Florida together. And the reason is those are the big focus states for the media coverage during the second wave of cases that we saw in the U.S. as a whole. So, what I think is really interesting to point out about these second wave states, or the hotspot states, is that there really is no second wave going on in these states, right? You can see early on when the original pandemic was happening, which is really mostly on the East Coast early on, there's very low daily new cases in these four major states. And then right around that same, June 10th, June 15th time period, these states really take off from a case perspective. And, what I like to tell people is it just looks like to me that these states aren't really having a second wave per se. I think they're more of, the virus just took a little bit of time to migrate down south from the East Coast or over to the West Coast with California. And that was why you kind of saw a delay between these states and kind of the original East Coast states. So the big second wave of cases in the United States as a whole, I think is really more akin to, just kind of a natural geographic spread of the virus than it is, reopenings or anything like that. And, another thing that's important to note is these states, largely speaking, have seen their case curves fall by about 70%. And they did it without kind of the lockdown public policy choices that we made early on in the pandemic. So it does look like we're finding better ways to kind of beat this virus, aside from the very severe public health restrictions that we had early on in the pandemic. So it does look like we're getting smarter at combating this thing. And yeah, you see kind of a little uptick here again. Could be more testing again, or just the return to school that we've all kind of been waiting for, and in some ways dreading. So that being said, I said the recovery is re-accelerating in the United States. Well, how do we even know a recovery is going on in the United States? And economists like to focus on employment data. It's kind of the best measure of economic activity, right? The more people employed, the more goods and services we're creating and things like that. So this is U.S. non-farm employment as measured by the Bureau of Labor Statistics. And heading into this pandemic, back in February, we had about 150, give or take, million people employed in the United States. And that number fell, roughly 23 million within 2 months, which is by far the fastest decline in employment the United States has ever seen before, even back to the Great Depression. And this is, a lot of it was just, fear around the pandemic, again, the kind of lockdowns for public health reasons. But what I think is interesting is we've seen consistent gains since the bottom in April. And we've gained back about 50% of the jobs lost in the United States during the pandemic so far. But what I think is really interesting here is the July and August levels here. So these last kind of 2 points on the chart. And the reason they're interesting to me is, these 2 months were taken during the survey period that included that huge second wave of cases where, were twice as many daily cases as we had early on in the pandemic. So I think it's interesting that the labor market has been able to kind of shrug off that second wave of cases, which really was more of kind of a regional spread of the coronavirus, and that's given us continued gains in employment, even though we have a higher daily new case count during these 2 survey periods than we did early on in the pandemic when we saw this huge decline. So the labor market has remained resilient. It's continuing to recover jobs. So some good news there, especially because I think it's important to point out that early on in the pandemic, any idea of a second wave of cases, basically we were convinced as a country and kind of from an economics point of view that would be a guaranteed double dip recession. We'd lose all the progress that we've made, but that hasn't been the case so far with the labor market and in other major portions of the economy as well, which we'll get into as later on in the presentation. So what I've got here is continuing claims for unemployment insurance. It's kind of another measure of the labor market that economists like, and we like this one a lot because it comes out weekly rather than monthly. So it's what we call high frequency data because it gives us a much faster, much more timely picture of the labor market than just looking at unemployment or non-farm payrolls does. So what I've got here is normal continuing claims in orange, and that's historically what we've always looked at. So every 2 weeks, people pay their FICA taxes from their paycheck, and that means if you're laid off, you're entitled to unemployment insurance as kind of a support system in the United States. And you can see this kind of, I like to call this maybe the institutional continuing claims numbers. This is people that are, working for a paycheck from a company. They're part of the official unemployment insurance system. So these kind of institutional employees, we saw their continuing claims peak back in, early May. And there's been consistent declines in the number of people receiving unemployment benefits since then. So that's a good sign. It means that the labor market is recovering pretty well for the institutionally employed people in the economy. But I think people make a good point and they say, well, hey, there's a lot more than people employed in the U.S. than just institutionally employed people, right? There's gig economy workers, there's independent contractors, people that are kind of outside of this official system. Well, the good news is that the CARES Act, which was passed by Congress early on in the pandemic, actually made provisions for these people. So this is continuing claims for pandemic unemployment assistance. It's kind of this whole new program. We've never had it before. It's the gray line on this chart. And you can see it starts at 0 back in early April, because that's when the program was created. And it quickly surged up to around 14 million people receiving these pandemic unemployment assistance claims. And recently we've seen pandemic unemployment assistance actually eclipse the number of people on official continuing claims. So kind of an interesting point in history. We've never really been able to measure the gig economy unemployment levels as well as official unemployment. But if you look up here at the top, I've added these 2 lines together, and that gives us a good read on total continuing claims, the total number of people receiving unemployment benefits. And those have, they were peaked out, kind of plateaued here for a while. And it looks like there's kind of I'd say a pretty shallow downward trend here, but these are stuck at kind of an elevated level. And, recently, there's been some questions about the pandemic unemployment assistance program because, keep in mind, these people that are receiving this, it's kind of on the honor system, right? They haven't been paying into the FICA tax system. There's no official tax ID connected with their name. So there's really no way to verify if they're actually unemployed. And there are kind of a lot of questions, especially coming out of California, which is now responsible for about 50% of total pandemic unemployment assistance claims, whether a lot of these things are fraudulent, basically. So I think probably the broader labor market looks more like the orange line than the gray line, but still I would like to see, some more downward momentum in total continuing claims. So that being said, we extended these benefits to people that in the past have never had access to them before. At the same time, we sent out $1,200 stimulus checks to everybody. We also boosted unemployment benefits by $600 a week, which for a lot of people that ended up being laid off was actually, came out to a larger amount of money than they were making on the job. And if you kind of put all that together, it's created a recession unlike anything I've really ever seen before. So what I've done here to kind of illustrate this for you guys is I plotted personal income growth along with retail sales growth. And, these move along pretty well with each other historically, and it's pretty intuitive why, right? If personal income starts going down, paychecks and things like that start falling off, people aren't going to be able to go out and do as much consumer spending, for example. So if you look at 2008, it's kind of a good example of a normal recession, right? And you basically see, personal income starts falling. It's falling for about 2 years after the 2008 recession. And that brings with it, a big decline in retail sales as well. Well, if you come over here to 2020 and the pandemic, you see that personal income never really fell during the pandemic. It kind of briefly did in April before we passed the CARES Act. But, following that, we've seen a huge surge in personal income from the CARES Act stimulus payments. And it's basically, government transfers are more than fully replacing lost incomes from unemployment. I think it's actually kind of a staggering statistic that today, people have more money, at least in an aggregate sense. Personal income is higher today than it was in February before the pandemic. And that's actually been reflected in retail sales as well. So, if you're looking for a V-shaped recovery somewhere in the U.S. economy, housing would be one place that's done really well, but retail sales have basically done a full V-shaped recovery and are back to kind of pre-crisis trends. So pretty amazing. But, at the same time that we're sending out all this money, there's kind of been a flip side to that, right? We helped a lot of people out during this pandemic. But the flip side is basically worries about inflation have been rising. And the reason is we're basically funding all of these stimulus payments with the Federal Reserve. They're printing money in the colloquial sense and buying U.S. Treasury bonds. So, if demand is higher than it was pre-recession, and at the same time measures of unemployment are elevated, measures of actual production like industrial production are still way down from a year ago. It basically means there's a mismatch between supply and demand. And that's why I think you basically, see people worried about inflation. That's why, gold had been rising, though recently it's kind of fallen off a bit. I think because of the, the lack of further stimulus from Congress. But gold is still way up from the beginning of the year. The dollar index has been falling. I think a lot of it is kind of this unprecedented fiscal stimulus that we've already had. At this point, I kind of don't think that we're going to get anything else from Congress before the presidential election. We're barely, we're almost, just a month away from this presidential election. We now have kind of the Supreme Court nomination and confirmation process taking up all of the legislative branch's time and kind of energy. So I think further stimulus is kind of not likely to happen. I just don't think the incentives are there, especially before such a big, contentious presidential election. But the good news is, personal incomes are still up from, pre-pandemic. So, a lack of cash doesn't seem to be the main problem to me right now. And, it's important to point out that people didn't just take all the money from those stimulus checks and those unemployment benefits and spend them all, the day they got them. In fact, the U.S. personal savings rate has been surging during the pandemic. So, it does look like people are saving a lot of that money for kind of a rainy day or to deal with the broad economic uncertainty in the economy right now. So this is the U.S. personal savings rate back to 1959. It's, all the record that we have. And you can see, we peaked out on personal savings rate around 37%, something like that. It's fallen the past couple of months, but, even down here, if you guys can kind of see over on this edge, even at the diminished level it's at today, it's still higher than any other pre-pandemic point on the personal savings rate record. So people have been stashing away a lot of cash. I think if you do kind of the back of the envelope calculation, it's something like $1 trillion to $1.5 trillion of extra money has been kind of stashed away. To me, that gives us a little bit more wiggle room with this stimulus. Is it going to happen? Is it not going to happen? People can kind of draw down on their personal savings that have been bolstered by the stimulus to kind of get through a month or two before we really need to worry about, consumer spending completely dropping off a cliff or something like that. So, that being said, how is the economic recovery doing? I said it's reaccelerating. So in my opinion, this is one of the best charts to kind of look at regarding the U.S. recovery in general, because I think it kind of, first, this is U.S. open table seated restaurant diners. So we all use the open table app to kind of book restaurants, or we did, pre-pandemic. And the reason I like this chart so much is, it represents the epicenter of the industry that's been hit worse by the pandemic, right? This is the service and hospitality industry. They've been hurt worse than anybody else. So, however they're doing, other sectors are probably doing better. So for that reason, it's useful. And on top of that, it kind of shows the broader trend of economic activity better than anything else. So you see a very similar line or shape of a line when you look at things like credit card spending or hours worked or the number of people getting on TSA, going through TSA security to get on an airplane, for example. U.S. hotel occupancy would be another good one. So, early on in the pandemic, you see the pandemic hits, we fall to negative 100% from a year ago on open table seated restaurant diners. And obviously, that's because of the lockdowns and kind of the public health response. We couldn't go to restaurants for a month or two there. But, like I said, we start bending that curve early on. I showed you guys that chart. We're bending the curve. We're seeing some pretty good recovery in U.S. open table seated diners. And then, right around June 10th, June 15th, if you look down here, lines up pretty well with that big second wave of cases we saw in the U.S. Basically, we hit a plateau for about, a month, 2 months here. And, since then, we started bending that curve pretty well again. And you've seen some pretty consistent upward momentum in this measure. So, I think the biggest thing to take away from this chart is, when we're talking about the possibility of a double dip recession or, worries about an actual second wave, New York gets a second wave for real, or Texas actually gets a second wave of cases, would we expect that to cause a double dip recession? And, I'd say that this chart shows pretty well that, what we should expect is basically a plateau of activity for a while as we, figure out what we want to do and kind of, deal with the new outbreak. But, we haven't seen anything like the plummet we saw early on when we peaked around 30,000 daily new cases. Here we're having 60,000 daily new cases and there's no plunge in activity. It's basically just flatline for a while as we got the wave in the south and the west under control. I also think that there's capacity restrictions are certainly holding this back to some extent, right? Restaurants, a lot of them don't have a ton of outdoor seating. Restaurants in general are kept to 50 to 25% capacity. So the fact that we're only down 40% from a year ago is kind of impressive to me in general. But it does look like, I'm not even sure what this big peak that happened here was, but we are on a pretty consistent upward trend here. So it does look like we've begun to reaccelerate, at least from the restaurant industry standpoint. And if the restaurant industry is doing better, it's a pretty good bet that other less affected industries are recovering as well. So, that being said, I get that that's only one data point, right? It's only U.S. open table. But, I think it's important to point out that over the past couple of months during the second wave of cases we've seen in the U.S., economic data has been much better than expected. So the way I'm showing this here is what's called the Citi U.S. Economic Surprise Index. And basically what they're doing is, before every major economic data point gets released to the United States public, whether it be housing starts or employment or personal income or durable goods orders, whatever it is, they go out and they survey a bunch of economists and they ask them, hey, what do you expect this to be? And that's the consensus number. So basically what the U.S. City Economic Surprise Index does is it takes the actual number, what the number actually comes in at, and they just subtract out the economist's consensus. So if data has generally been coming in way above consensus, the Economic Surprise Index will be way in the positive. If it's way below consensus, it's going to be way in the negative. So what's interesting here is you can kind of see how economists have missed the boat both ways on this pandemic situation. So early on, you can see the City U.S. Economic Surprise Index plunges. It's basically the worst on record. Maybe 2009 was a comparison point, but I think the reason is data was coming in way worse than generally speaking economists thought it would be. And the reason is that we had never shut down the economy before during a pandemic. It's kind of a whole brand new public health response. So I think that kind of threw a lot of forecasts. It made consensus estimates way worse, or actual way worse than consensus. That's why you see the big plunge here. But recently, during this big second wave of cases that we've been seeing in the U.S., basically every economic number has been coming in way above consensus. And I think this just goes to show again, broadly speaking, everybody thought that a big second wave of cases in the U.S. would cause a double-dip recession. So when all of a sudden we're in the middle of the second wave and economic data is coming in much better than expected, that's reflected in the City U.S. Economic Surprise Index. So it's just another data point that kind of shows that the U.S. economy has been much more resilient than basically consensus estimates thought it would be. And I think, kind of looking towards the future, if we do get, actual second waves across the country in the fall, I think this is something to keep in mind, that it's not necessarily going to cause a double-dip recession. In fact, I think the evidence is pretty clear that, we're going to be able to kind of growth will slow down. We'll probably plateau in activity again, but we'll muddle through and continue to grow over time as we get that under control. So the last thing I want to talk about here before we get into the election and kind of some stuff around that is just comparing some of the outcomes from coronavirus across the world so far. So what I've done here is I've just compared individual U.S. states to individual European countries. We all kind of have similar demographics. It's easier when you break down the states because then they're kind of similar in population and size to European countries. I just kind of look at coronavirus deaths per million. So we population adjust all of this to kind of get an apples to apples comparison. And what you see early on is, the East Coast got hit worse than anywhere else in the world, pretty much, when you're talking about New Jersey, New York, Massachusetts, and Connecticut. And then, you go through the European countries like Belgium, Italy, Spain. They're kind of the middle of the pack along with the United States if you look overall at the whole country. And then you come down to Texas, France, California. They've done much better on a relative basis. Arizona has kind of done worse, but from a comparison perspective, they've done much better than kind of the original first hit states. And then you've got Sweden, which I think is a really interesting control group because they're kind of the they never lock down state or country in the world, right? And they're below the U.S. average. They're below UK, Italy. They've done pretty surprisingly well in general. So I think a lot of people would look at some kind of chart like this and they basically take some kind of political point from it where, hey, Texas did better because it's Republican than the East Coast, which is Democrat or something. And that is not what I'm trying to point out here. In fact, I think that's the exact wrong message to take from this. I think what's important to note is that the reason places like Texas and California did better in a comparison is because they had more time to figure out their response to this pandemic, right? Early on, we got hit with this thing. We didn't have personal protective equipment. We didn't have testing. We didn't have tracing. We didn't know to use convalescent plasma. We didn't know, how to treat this virus in general. We didn't know who was at risk. So those extra several months really gave the second wave states a lot more time to prepare. And I think it shows up in basically the data that we've been getting much better at at kind of combating this virus over time. And basically what I would look at this chart and I would take away from it is, again, if we do have kind of a second wave of cases in the United States, in different regions, then I would expect the results of that second wave to be much better than what we saw early on. So if New York or New Jersey does see an actual second wave, I would not expect the same kind of results that they saw early. They're going to be much better at responding to it and dealing with the virus outbreak going forward than they were early on because of again, just they didn't have the information and the testing and the infrastructure that we have now. So last slide here is just some legal language here that we got to put on. But I do want to talk about the election a little bit. I guess from an investment perspective, the biggest fears or the biggest kind of concerns people have would be around tax policy. So specifically, the Biden administration is saying that they're going to raise corporate taxes. That would definitely impact, the value of stocks, for instance. They're saying that they want to raise, capital gains tax rates to the same level as income tax rates. So that would be a pretty significant hit as well. So I think specifically with the capital gains tax rate, one thing to look at is, people selling before the end of the year, right? And that could definitely have an impact on markets under, a scenario where Joe Biden wins, because people want to sell before, basically they're going to have to pay a higher tax rate in the future. So I think you could see some temporary volatility from that. But generally speaking, I think that's going to be temporary over time. I think we'll make those gains back. And really, if I had to make a guess, I'd say, if the Biden administration does get in the White House, even if they take the Senate, which is going to be crucial for any kind of major legislation they pass, it's important to point out that, I don't think that they're going to focus on raising revenue. I think basically, nobody is worried about the deficit, not the Republicans, not the Democrats. I don't see the reason why they would burn political capital focusing on, trying to raise taxes in the middle of an economic recovery. I think much more likely what we see is they basically focus all their political efforts on passing, Biden's major spending proposals. So I'm a little less worried about kind of tax hikes in general than I think maybe the consensus is there. It's important to note that, you can only do, one or two things at a time, even if you do take over kind of the executive and the legislative branch. And then the other thing I would point out, and this is kind of my biggest concern regarding the election in general, is, basically the transfer of power situation where, we have a lot of people that say they're going to be voting from home. So basically using a lot of mail-in ballots, many more than we've really ever done before in the United States. And I think this could create a scenario where basically there's not a winner announced on election night. And it could be, several weeks or months before a winner is announced. And that would certainly cause a significant amount of volatility in the markets, as basically people constantly try to discount, who's going to be winning, what policies are going to go through, and there's just a lot of uncertainty for an extended period of time. So that would be my biggest concern around the election is, don't expect this thing to be over on election night. I think it's going to kind of get dragged out, similar and maybe worse than, George Bush versus John Kerry in 2001 with, the situation in Florida. So keep that in mind. But, I do think, we'll continue to crawl our way out of the hole from COVID. I think the economic recovery is going to continue. I think that's going to be reflected in U.S. stocks, even though there is going to be a lot of volatility, going forward as there's cases from COVID or there's, election-related uncertainty. So with that, I'll pass it back to the moderator, and we can do any Q&A if we have it.
Mm-hmm. Hey, Bryce, thank you. That was terrific. I think you did a great job. We don't even have any questions. That's how good it was. We don't have any questions. But it seems as though what's happening is, from all your slides, if I was to distill this, is that the country's just learning to live with this virus. And even though we have, rebounds in particular geographic areas, we still just seem to be on a glide path higher as far as economic activity.
Yeah, and I think if I could, distill it even more, it's that don't bet against the U.S. economy. It seems to be extremely resilient. People seem to be adapting to this better than pretty much everybody expected. And yeah, unfortunately, this is a virus that's widespread in the country. We weren't able to stop it, but that doesn't seem to be completely eliminating prospects for continued economic recovery, in my opinion.
Mm-hmm. The one thing that's worrisome is we've been able to save money through all this and spend money through all this, and that was because of the government stepping in a huge way. It seems like that's all on hold right now, going into the election. Then, if we have a contested election that could go on for who knows how long, that puts that on hold for that entire period too. I would think that would have to have a negative economic, drag on our economy. Would you agree with that?
Yeah, I'd say the big thing to look for is the personal income data. Even the past couple of months, as the stimulus checks rolled off, we only sent those out once. The actual amount of boosted unemployment benefits has been falling. Personal income has still been rising, surprisingly, I think, for a lot of people. And the reason is that the unemployment rate has been falling so rapidly. So even though a lot of this government stimulus money is disappearing, basically wages and salaries are more than fully replacing it. But I think you make a good point that, at a certain point, a lot of these easy to recover jobs are going to already be recovered. And at that point, if stimulus money is completely locked up because of a contested election or whatever it is, then you could see, the actual level of personal income in the United States start to trend down. And that would be definitely an issue going forward.
Yeah, because there's going to be some number, is it 10 million, 15 million, whatever it is, they're kind of, if not permanently lost for a long time, those jobs. Yeah.
Yep.
Bryce,
and
thank you.
Small businesses have been kind of eradicated. A lot of them have been, and it takes time to, basically file the permits, get the loans, get everything set back up to rehire. So that's definitely going to take. It's going to take longer to basically get to all the unemployed jobs back than it is to get back to the same level of economic activity that we had pre-recession.
Yeah. Well, thank you again. Thank you very much for sharing your thoughts with us and First Trust's thoughts with us. And I want to remind everybody that this will be on our website and on Facebook. And thank you very much.
Well, thanks for having me.
Right.
It was great talking with you.
All right. Have a great day.